What if I told you that in 2026, protecting your investment capital is just as important as growing it? With AI-driven market volatility and rapid shifts in high-frequency trading, preserving your wealth has become more complex than ever. In this video, we'll break down the top 5 investment rules that will help safeguard your capital and protect you from costly mistakes. Stick around until the end for actionable steps to fortify your portfolio and ensure your wealth stays safe, no matter how volatile the market gets. 1. The maximum drawdown circuit breaker. One of the most effective ways to protect your wealth is by setting a clear limit on how much you're willing to lose. In 2026, markets are more unpredictable than ever, and it's easy to get caught up in the momentum of rising prices. However, without a strategy to exit in a downturn, a normal market correction can quickly turn into a massive loss. That's where the maximum drawdown rule comes in. This rule involves establishing a hard exit strategy, such as a sell at -15% policy, and automating it through your brokerage app. When you set this rule, a trailing stop loss automatically adjusts as the price rises, but if the value falls by 15% from its peak, it triggers a sale. This tactic protects you from small fluctuations snowballing into major losses that could take years to recover from. With a built-in circuit breaker like this, you'll never find yourself stuck with an asset that's drastically declined, keeping your portfolio stable. 2. The 3-layer liquidity buffer. A common mistake many investors make is putting money into investments they might need in the near future. Having money locked up in long-term assets during an emergency can lead to forced sales at a loss. The key to protecting your principal is ensuring you have easy access to liquidity, especially during market downturns. The 3-layer liquidity buffer strategy helps you do just that by organizing your wealth into 3 layers for easy access. The first layer consists of 1 month's worth of cash in a local checking account, giving you immediate access to funds when needed. The second layer should hold 3 to 6 months of living expenses in a high-yield money market account with 72-hour access, ensuring you have a safety net for short-term needs. The third layer is for long-term investments, such as stocks and bonds, which should be held for 5 years or more. 3. Verify the proof of reserves. In the era of digital finance, many new platforms, especially fintech apps and neobanks, offer enticing high returns on investments. While these platforms may sound appealing, it's essential to verify their legitimacy and financial stability before you invest. This is where verifying the proof of reserves becomes crucial. Before you commit your capital, always check whether the platform is insured and regulated. By choosing platforms that offer proper insurance and oversight, you ensure that your principal is protected and recoverable if anything goes wrong. This step helps you avoid investing in platforms that might disappear into a legal void, leaving your money unrecoverable. For the inverse correlation stress test, diversification is one of the most important strategies for reducing risk in your portfolio, but simply owning a variety of stocks or ETFs isn't enough. If all your assets are tied to the same sector, such as 5 different tech ETFs, your portfolio is still vulnerable to sector-specific downturns. To protect your wealth, you need to look beyond traditional diversification and include inverse assets. Inverse assets, such as gold, treasury bonds, or specialized bear funds, tend to move in the opposite direction of the broader market. When stocks are down, these assets may either stay stable or even increase in value, helping to balance your losses. 5. The replacement cost valuation. When markets are hyped about the next big stock, it can be tempting to jump in and ride the wave. However, the danger here is that many of these hot stocks are often overvalued. To protect yourself from market bubbles, you should always consider the replacement cost valuation when evaluating a company's stock price. The idea behind the replacement cost rule is simple. The market capitalization of a company should align reasonably closely with the cost of replacing its physical or intellectual assets. If a company is valued at 100 times its actual revenue or assets, it's likely in a speculative bubble waiting to burst. By choosing value-based investments, you lower the chance of being exposed to speculative bubbles that could lead to significant losses. There you have it, the top 5 investment rules that protect you from losing money in 2026. From the maximum drawdown circuit breaker to the replacement cost valuation, these rules are designed to help you safeguard your wealth in an unpredictable market. The key takeaway here is that protecting your capital is just as important as growing it. If you found this video helpful, don't forget to like, share, and subscribe for more tips on safe investing and wealth protection. Let me know in the comments which of these investment rules you've already put into practice, and I'll see you in the next video.